This is the Sleeping Giant Podcast, Episode 2.
Welcome to the Sleeping Giant Podcast,
where it's all about freeing your mind,
so you can take ownership of your life and prosper in your newfound freedom.
The sleeper must awaken.
And now,
your host, Angus John Pratt.
Greetings, programs. Welcome back to another episode of the Sleeping Giant Podcast. It is Tuesday, July 4, 2017. Happy Independence Day to my fellow countrymen, and a belated Happy Canada Day to our neighbors to the north. Folks, today I'm going to talk about money. Yes, the green stuff. Well, it's green in this country anyway. More specifically, I'm going to talk about money and currency. There is a difference. And then we're going to talk about how currency is created. Don't roll your eyes and say, oh, this is boring, I don't like economics. Well, this isn't exactly economics we're going to talk about. I am begging you to go ahead and continue listening today, folks. This is stuff you need to know. It's critically important for you to understand because it affects us all so profoundly. Now, a few days ago, I was talking with a friend of mine, and out of the blue, he says, do you realize that the Federal Reserve doesn't have any money? Do you realize that they have no funds? And I said, yeah, I did. You got to listen to an episode of my podcast that I'm going to be putting out this weekend. So, Brian, you had excellent timing to bring that up because that very fact is an interesting step in the currency creation process. So stick around. It's going to get interesting, folks. Since we're talking about money and currency today, I'd like to share a couple of stories with you about kind of the state things are in this country. The first is from a site called yourfirstmillion.org, and it's entitled, Putting It All Into Perspective. This is how bad the U.S. national debt problem really is. Since the Great Recession, which started in 2008, we saw many local municipalities across the country throw up their hands in defeat and file for bankruptcy. Multiple cities and counties from all over began to declare bankruptcy and restructure their debts. This was quite shocking to most, since municipal bonds have always been considered a safe and secure asset class. Unfortunately, many bondholders received significant haircuts on their quote-unquote sure bets. The following is a list of the local governments that either declared bankruptcy or some other similar form of default on their debts. And it has a bullet list here, including the city of Detroit, the city of San Bernardino, California, the township of Mammoth Lakes, California, the city of Stockton, California, Jefferson County, Alabama, the city of Harrisburg, Pennsylvania, the city of Central Falls, Rhode Island, Boise County, Idaho, the city of Vallejo, California, and the Commonwealth of Puerto Rico, which is a U.S. territory. Up until 2017, the city of Detroit was the largest municipal bankruptcy on record, defaulting on $18 billion of debt in 2013. This year, Puerto Rico declared bankruptcy, eventually defaulting on the territory's $73 billion of debt and making it the new largest municipal bankruptcy in U.S. history. Although local governments can use bankruptcy laws to restructure their debts and start all over financially, it is U.S. law that states cannot declare bankruptcy, which will come into play in the next story. This makes it very difficult for states such as California, Illinois, and New York who have massive spending deficits and debts. Puerto Rico, which is really more like a state than a municipality, was allowed to declare bankruptcy as a municipality due to the fact that Puerto Rico is not a state. Interesting little workaround there. The United States as a country is in a far worse financial condition than any of the municipalities that were listed above. Here is a comparison of the debt-to-income ratios for Detroit, Puerto Rico, and the United States government to help illustrate just how bad things really are. At the time of the bankruptcy, the city of Detroit defaulted on $18 billion of debt and unfunded liabilities. At the time of bankruptcy, the city of Detroit had an annual tax revenue of $1.1 billion. At the time of the bankruptcy, the city of Detroit had a debt-to-income ratio of 16.36. That means that the city's debts were 16.36 times larger than its annual revenue. At the time of its bankruptcy, Puerto Rico defaulted on $73 billion of debt. 73 compared to Detroit's 18. And unfunded liabilities. At the time of bankruptcy, Puerto Rico had an annual tax revenue of $9.7 billion. At the time of bankruptcy, Puerto Rico had a debt-to-income ratio of 7.5, which is bad, but far better than the city of Detroit's ratio. And now the 2017 financial state of the United States of America. Currently, it is estimated that the U.S. government has more than 220 trillion, with a T, folks, 220 trillion in debt and unfunded liabilities. The official public debt is $19.9 trillion, but most people do not realize that this does not include all of the unfunded liabilities, such as Social Security, Medicare, federal pensions, etc., which are estimated to be more than $200 trillion. Currently, it is estimated that the U.S. government annual tax revenue is about $3.4 trillion. Based on these estimates, the U.S. government's current debt-to-income ratio is a whopping 64.7. 64.7 times as large as its annual tax revenue. This makes the U.S. government 3.95 times worse off than the city of Detroit when it was declared bankrupt in 2013. Also makes the U.S. government 8.6 times worse off than Puerto Rico was when it declared bankruptcy earlier this year. So that's a very interesting story on the state of our finances in the U.S. As we come to discuss how currency is created later on, you'll see how this has such a large impact on us. So that story kind of leads into this current news about the state of Illinois. From Fox News, I have some snippets here. Illinois' budget crisis has become so dire that the state is in danger of entering a financial quote-unquote death spiral as a prominent ratings agency threatens to downgrade the state's credit score to junk status. Doing so would increase the cost of borrowing, worsening the deficit and making it even harder for taxpayers to dig out of the hole. We're in a death spiral. Illinois has the worst pension crisis in the nation and needs the boldest reforms. Ted Dabrowski, Illinois Policy Institute's vice president of policy, told Fox News. There is no doubt that junk bond rating is on its way. Lawmakers are now in a special session in an effort to break the budget impasse prodded by Republican Governor Bruce Rauner, who has referred to his state as a banana republic. The state currently faces $130 billion in unfunded pension obligations and a backlog of unpaid bills worth $15 billion. A downgrade to junk status would increase the cost of borrowing for critical infrastructure or refinancing existing debt. Swinging over to Bloomberg today, Illinois lawmakers are racing to push through legislation to end a record-long budget impasse and avoid becoming the only U.S. state with a junk credit rating. Lawmakers are in session Monday after the Democrat-run House of Representatives approved an income tax increase with 15 Republican votes on Sunday, signaling bipartisan will to end the stalemate, even though Governor Bruce Rauner vowed to veto it if the measure clears the Senate. The House also sent a $36 billion spending plan to the Senate amid concern that credit rating companies will pull Illinois' investment grade rating if a budget isn't enacted. Illinois has entered its third year without a budget. because of a clash between the Republican governor and lawmakers over how to close government's chronic deficits. Unpaid bills have soared to a record $15 billion, and by August, the state is set to run out of money for key expenses for the first time since the stalemate began, according to Comptroller Susana Mendoza, a Democrat. That means school funding, state payroll, and pension payments could be affected. In his statement announcing his planned veto of the tax increase, Ronner criticized lawmakers for continuing, quote, out-of-balance budgets with no real reform, unquote, blaming House Speaker Michael Madigan, a Democrat who controls much of the legislative agenda. The House bill would raise individual income taxes from 3.75% to 4.95%, and corporate levels from 5.25% to 7%. Those are some pretty hefty increases, folks. The fiscal pressure intensified on Friday after a U.S. federal judge ruled that the state must boost its Medicaid-related payments to chip away at the backlog of unpaid bills. Comptroller Mendoza said the ruling brings Illinois' finances, quote, from horrific to catastrophic, unquote. She said while bond payments will continue uninterrupted, payments to pensions, state payroll, schools, and local governments will likely have to be reduced. I think this situation is getting out of hand and holds significant implications for the rest of the country. Some of us have been expecting this scenario for quite a while now. Those localities and counties mentioned in the first story were the canary in the coal mine. Illinois' failure could well be the Bear Stearns or even the Lehman Brothers moment. The stock market is back in a bubble again at all-time highs. Bonds are actually in a super bubble. Even real estate has never completely revisited fair market value after the global financial crisis and has since bounced back into a bubble as well. The next crisis will be much more severe, and this could be the beginning. Fed Chair Janet Yellen just claimed a few days ago that we won't see another major financial crisis in our lifetime. But I think that just about seals the deal that we will. Remember how great Ben Bernanke said the economy was before September of 2008? I hope you're either prepared now or ready to get prepared rapidly. And now, let's get on with the main event. Now, most of us think of money and currency as the same thing, right? But they are definitely not. After listening to this episode, my hope is that you will do your level best not to call the dollars or euros or pounds in your pocket or wallet money any longer. I know it's hard. Everybody calls it money. At least think of it in your head, if you can, as currency. Just thinking about the terms will cause you to remember that currency is not money. So what's the big deal and what's the difference? Well, this is an important topic because currency is such a big part of our lives. We spend most of our lives working for it. We save and invest to cover expenses. We're stressed out when we don't have enough of it. We wish to have more of it so we can improve our lives and be more charitable. We have to save for the future when we can't work any longer. We use it almost like language. See, currency has a number of properties. It's a medium of exchange. That's usually why we think of it as money. We use it to conduct commerce, right? We trade currency for stuff. It's also a unit of account, right? So we know we can track how much has been transacted. You can track purchases, expenses, and nominal values of the goods and services that we purchase. Currency is also divisible. That just means that you can make change, right? I give you a $100 bill, you can break it down into smaller quantities. Currency is durable. You know, it's not indestructible, but it's pretty darn durable. I mean, it's not going to evaporate or blow away in the wind. It's not going to erode and suddenly be less if you keep it in your wallet your entire life. You know, a dollar bill today is probably going to be just as durable in 100 years as it is now. It's not physically fragile. It's also portable. Currency is portable. It has to be small enough to carry with you, right? I mean, you could use something else like a barrel of oil as currency, but I'd like to see you carry that around. And lastly, currency is fungible. And that just means that it's interchangeable. Each unit is the same as every other unit of its kind, of its denomination. But money has one more critically important characteristic. It maintains its value over long periods of time. I'm not talking about a decade. I'm not even talking about a century. I'm talking long periods of time, hundreds or thousands of years. The US dollar, for example, has lost over 98% of its value since 1913. That's just over 100 years ago. And it's lost almost 100% of its value. Does that sound like it's been a store of value over a long period of time? See, since 1971, all the world's currencies are now 100% fiat. That just means that it's not backed by anything other than government decree. And it's debt and confidence. But there's nothing tangible behind fiat currency. It has no intrinsic value at all. The scary thing is how it's created. If everybody were to learn what I'm about to teach you, I think confidence would probably be lost. Government decree wouldn't matter and the debt would be defaulted on. This knowledge should change your life profoundly. All right? Today's currency creation is an absolute scam from beginning to end. Just about all modern societies create currency the same way, but I will be discussing the US dollar specifically because I'm an American. And for the time being, the dollar remains the world's reserve currency. It all begins with deficit spending. That's just a way of saying spending more than the government collects in revenue. Usually starts on the campaign trail when they're out there promising you this and promising you that. Where do you think the money comes from? Where do you think the currency comes from to pay for that? Well, you're about to find out. To pay for all that spending, the government needs currency it doesn't have. So the Treasury issues a bond. All right? A bond is just a fancy, frilly IOU. It's a promise to pay in the future plus interest. And this is what makes up our national debt. It's to be paid back by all of us and our children's generation and our children's children's generation and probably even further ad nauseum through taxation. That's right, they're actually stealing prosperity from the future to pay for what they're promising to provide for you today. And that's just plain wrong. Thomas Jefferson made that clear when he said, "It is incumbent on every generation to pay its own debts as it goes," a principle which, if acted on, would save 1/2 the wars of the world. And George Washington had something to say about this as well. He said, "No generation has a right to contract debts greater than can be paid off during the course of its own existence." Perversely, we've passed the point of ever being able to pay it back, but we still have to pay for it as if we could. More on that later. What happens next is that the Treasury holds an auction. They sell off these bonds to the world's largest banks. These banks buy a chunk of our national debt, and then they profit from it through the interest on the bonds. Incidentally, the banks actually profit from every step of the way in this currency creation process. At the expense of us, of course. So what's next? Well, these big banks then get to sell the bonds to the Federal Reserve, again at a profit. This is called open market operations, but it's really nothing more than financial sleight of hand. Here's another sick thing about this whole scam. The Fed pays for the bonds with a bad check. They actually write a check that should bounce because it's drawn on an account with nothing in it. It always has a zero balance. How is this even possible? You can look it up on the Federal Reserve's own website. From the Boston Federal Reserve Bank in a publication called Putting It Simply. It says, when you or I write a check, there must be sufficient funds in our account to cover that check. But when the Federal Reserve writes a check, there is no bank deposit on which that check is drawn. When the Federal Reserve writes a check, it is creating money. When the Fed hands that check over to the bank, currency is instantly created. The banks then use that currency to buy more bonds at the next auction, and the cycle goes on and on. Right? So remember, the cash is used to pay for the bonds. Therefore, the cash goes to the Treasury, and the banks get richer all along the way for essentially doing nothing. Now, if you think about it, a check is just another IOU. So at the core of this whole mess, the Treasury and the Fed are really just swapping IOUs. Cash is nothing more than a magical byproduct. Originally, paper currency was a claim check or a receipt on something tangible. You could take a $20 bill to the bank and turn it in for real money, which at the time was gold. Now it's just a claim check on an IOU, being the debt. And this is where all paper currency comes from, this bond auction process. It's what the Treasury mistakenly calls base money. Since cash is a receipt for something intangible, it's much more accurate to think of base money as just a supply of numbers. The Treasury then deposits the currency in the many various branches and departments of government. Government then does its deficit spending primarily on public works, what we call infrastructure, social programs like Medicare, Medicaid, and the like, and war, what we euphemistically refer to as defense. Government employees, service members, and contractors all deposit their paychecks back into the banks. Now, here's a big shocker for most folks. When you deposit your funds in the bank, you're not just handing them over to be held safely in trust for you, right? You're actually loaning it to the bank so that they can conduct their business. They make loans with it. They're allowed to gamble in the stock market. They can buy real estate. Pretty much anything within some pretty liberal legal limits they can use your money for. Your currency. Your numbers. You ever notice that bank buildings are usually some of the biggest in most cities? Your bank deposit's hard at work. Another shocker for those who don't understand how this all works is fractional reserve lending. This means that the bank is only required to hold a small portion of deposits in reserve. We'll just use 10% for simplicity's sake. This just maintains a degree of liquidity should some people actually want some of their cash. The rest, they're free to loan out. There's not even close to enough currency at the bank to pay back even half of their depositors. So your account is now made up of a combination of a claim check on an IOU, paper cash, and an IOU on a claim check on an IOU, bank credit, that other 90%. Here's another quote from the Fed. Commercial banks create checkbook money whenever they grant a loan, simply by adding new deposit dollars in accounts on their books in exchange for a borrower's IOU. If you deposit $1,000, the bank can lend out $900 without even telling you. Say the borrower is going to buy a new car with the funds. He deposits the $900 into his bank, and another $810 can be loaned out on that. Process just repeats over and over again. Under a 10% reserve requirement, that original $1,000 of base currency from the Treasury can turn into $10,000 or more of bank credit, which is now also currency. And it's this fractional reserve process where most of the currency supply comes from. 92 to 96% of all currency in existence is created within the banking system, not by the government. I'll go into more detail on inflation in a future show, but the more currency there is in the system, the more prices rise. And the currency supply is increasing all the time. What's really twisted here is that the rest of us go out and work for this trash. We trade our time and our effort and our talent, which is actually our true wealth, for pieces of worthless paper and phantom digits on a computer screen. So we are actually what gives currency its value. But then we get taxed on it. We work for this stuff and then we get taxed on it. The IRS in this country collects our taxes. They ship it over to Treasury. Treasury ships it over to the Fed to pay down the principal and pay the interest on the bonds. The banksters get richer from the government essentially committing fraud. You realize that there was no need for a personal income tax in the United States before the Fed? You think that's a coincidence? I don't. We'll definitely talk more about the Fed down the line. Once you break all this down to its essence, what you find is that there is interest owed on every dollar in existence. And we know how dollars are created now, right? They're borrowed into existence. If you borrowed the very first dollar, where does the currency come from to pay the interest on it? That's right. You have to borrow that too. So the debt just ratchets up and ratchets up and ratchets up in greater proportion than the amount of cash buildup. And it's a completely fraudulent system. It's like a Ponzi scheme, but actually much worse. There is never enough currency in the entire system to ever pay the debt. The debt always has to be bigger than the currency supply. And it must always grow or the system will collapse. That's why I talk of debt ceilings and living within our means, paying down the debt. It's all pointless. It won't do any good, and it's not even possible. There's absolutely no reason to have a debt ceiling because we have to always raise it until we're ready for the system to stop. And no politician wants that to happen on his watch. They kick the can down the road. And the more this goes on and on and on, the more energy is built up, the bigger the collapse will be. Does that sound sustainable? No. That which cannot go on forever eventually won't. You ever wonder why the rich are getting richer and the poor get poorer? Why the 1% owns everything? This is it. It's a truly evil system of legalized theft. And the system is intentionally complex and confusing. They don't want you to understand it. That's why I believe it's so important to help you understand it, to improve your education. There's a very famous economist named John Maynard Keynes who I seldom agree with, but I do agree with what he wrote when he said, "By this means, government may secretly and unobserved confiscate the wealth of the people, and not one man in a million will detect the theft." What do you think would happen if everybody knew about this? You remember all this started when the government created a bond. The very word bond is the root word of bondage. This system is designed to enslave you. Heavy stuff, folks. I have a parting quote for you from a former director of the Bank of England, Sir Josiah Stamp. He said, "The modern banking system manufactures money out of nothing. The process is perhaps the most astounding piece of sleight of hand that was ever invented. Banking was conceived in iniquity and born in sin. Bankers own the earth. Take it away from them, but leave them the power to create money and control credit, and with the flick of a pen, they will create enough money to buy it back again. But if you want to continue as the slaves of bankers and pay the cost of your own slavery, let them continue to create money and to control credit." Now, that whole lesson on currency creation, it's basically a paraphrased version of episode 4 of a video series called Hidden Secrets of Money. The Hidden Secrets of Money was created by Mike Maloney of goldsilver.com. I came across him several years ago, and a big part of his mission at his his precious metals dealership is education. And I've just come to realize how important it is to be educated on the topic of economics and finances. The rest of the series is amazing. I'll put a link to it in the show notes. I highly encourage you watching both episode 4, which is directly related to today's show, as well as the entire rest of the series is very educational. Go have a look at it. And thanks to Mike for putting it together and encouraging us to share it. Well, now that you know the difference between money and currency and how currency is created, I'm going to wrap up today with one more story. This one's from Katie Hill at moneyish.com. It's called "We're Making a Lot of Financial Mistakes. You can take this to the bank. Americans are messed up about money. A slew of new surveys and data have come out revealing that we don't save enough, we spend money we don't have, we have our financial priorities backwards, and more. Here are 5 new stats that prove Americans are backwards about money. Number 1, about 1 in 4 literally have no emergency savings. A survey released Tuesday by Bankrate.com found that 24% don't even have a single dollar saved for an emergency. And that's just one of many surveys showing how little we saved. A survey released in January by Bankrate found that nearly 60% of Americans wouldn't have enough to pay for a $500 expense if it came up unexpectedly. What's more than 1 in 5 say they'd slap down their credit card to pay that expense, while others say that they would mooch off family to get the cash. Experts recommend that Americans have at least 3 to 6 months of income in the bank to pay for unexpected emergencies. Number 2, we are more worried about paying for our next vacation than about saving for retirement. That's the finding of a study released this week by Country Financial, in which Americans report being more concerned about affording that vacation, 36%, than having adequate retirement savings, 32%. That may explain in part why more than half of Americans will be broke when we retire, according to a survey from GoBankingRates.com. Number 3, millions of us hide money from our spouses and partners. An estimated 12 million Americans confess they have kept a source of money secret from their romantic partners, according to creditcards.com. That's typically not smart, experts say. Quote, anytime you get into these kinds of things where you are operating behind the scenes, it usually comes out at some point, unquote. Corey Allen, a marriage and family therapist, told creditcards.com. We can't keep things hidden, especially in today's technological world. Any spouse who has any kind of suspicion can become a detective and find it. Interesting. Number 4, we prioritize paying the wrong bills first. When we can't pay our bills, we make bad choices about which to pay. Consumers in financial distress tend to prioritize unsecured personal loans ahead of other credit products, such as auto loans, mortgages, and credit cards, according to a study from roughly 2 million consumers who had all 4 types of debt out this week from credit monitoring service TransUnion. But experts say that's a backward way to handle these bills. And number 5, we've racked up $1 trillion in credit card debt. And that's just a fraction of what we owe. That's according to data released this year from the Federal Reserve, which found that U.S. consumers owe $1.0004 trillion on their cards. That's up 6.2% from last year. This is the highest amount owed since January 2009. Didn't something happen around that time, end of 2008? I seem to remember something happening back then. What's more, this isn't the only consumer debt to top $1 trillion. We now also owe more than $1 trillion for our cars and for our student loans, the data shows. Interesting stuff, folks. You gotta get your money right. Well, I hope this show has been illuminating for you today. Please use this knowledge to improve your financial decisions, and don't be shy about sharing it with people in your life. Thanks so much for listening today, everyone. As always, I appreciate your attention. I'm very grateful for your support. Come hit us up over at facebook.com/sleepinggiantpodcast. Post your thoughts about this stuff. Let us know what you think. You can also email me directly if you have questions or suggestions for the show. My address is angus@sleepinggiantpodcast.com. Stay safe in your holiday revelry, and until our next communion, see the cage, break the chains, free another.
The sleeper has awakened.